Good morning and welcome to the Killik & Co market update. One notable thing that's happened this week is that the iron ore price has caught up with the gold price for this year to date. Gold is historically seen as a safe haven investment and it tends to do well when people are worried about wider stock markets, so unsurprisingly it's done fairly well for this year to date. If you have a look at this chart here, you can see gold in the pink and iron ore in the green, and unsurprisingly gold has performed consistently well over the last few months. Iron ore, on the other hand, is a key ingredient in the production of steel. It's needed for infrastructure and it tends to do well when economies are growing. So perhaps unsurprisingly, at the start of January, when the coronavirus really started to take hold, we did see quite a fall in the price of iron ore. And the price remained in negative territory in percentage terms compared to last year until May of this year. And then we saw quite a big spike in the price to the extent that it's now on an equal year-to-date return with gold, which really is quite surprising. The main reason for this is China. China accounts for a huge proportion of global iron ore demand. If we take a look at the two major iron ore miners on the London Stock Exchange, Rio Tinto and BHP Billiton, we can see that nearly half of their revenues are attributed to China. China has recently started to return to growth according to the country's latest GDP figures, so that will have caused a positive impact on the price of iron ore. The Chinese government has also announced a big infrastructure project to try and promote growth in the economy as the economy recovers from the coronavirus. But another issue is the fact that China is currently battling the worst floods it has experienced for 30 years. There are huge floods along the Yangtze River and millions of people have had to be evacuated, and there's been huge damage to property all along the river. So repairing that property will create demand for steel and therefore iron ore. There's also speculation that China has been producing and stockpiling steel because a lot of its steel production factories are based along the river, and there is some concern that these factories could be damaged as the floods worsen, and therefore the country feels the need to stockpile this commodity at this moment in time. Corporate reporting season began this week, and investors have been watching very closely to see how companies have fared over the last quarter. I think there was a particularly high amount of focus on the results for the US banks, probably largely because the last stock market crash that we had was very much a banking crisis, and therefore there has certainly been a degree of nervousness around the banks this time around. However, most of the US banks have already reported results, and generally these results were ahead of expectations. A few trends that we saw in the results for the US banks. One was a big increase in revenues from trading. Because markets have been so volatile over the last few months, that has led to an increase in levels of trading, and that has been good for bank revenues. Investment banking revenues have also been strong, largely because banks have been so heavily involved in helping other companies raise money to get them through this coronavirus crisis. So whether they're helping them raise money by issuing debt or issuing equity, that is good for the investment banking revenues. There has been a decline in interest income, not surprisingly because interest rates are even lower than they were this time last year. There's also been a large amount of bad loan provisions that banks have been making use of, so banks have been setting large amounts of money aside to cover potential bad loans resulting from the coronavirus crisis, and this has impacted profits. But the fact that banks can and are able to and are willing to set this amount of money aside, I think really highlights just how much more cautious and how much stronger these banks have become since the financial crisis. Let's have a look at JP Morgan's results as an example. The bank reported revenues that were actually 15% higher than last year. However, profits were lower because of the amount of money that the bank has set aside to cover potential future bad loans. And these results were fairly typical of the bank results that we've broadly seen across Wall Street. But all in all, banking results so far have been seen as fairly reassuring. Also on the subject of earnings season, we had results out from Netflix last night, and these actually really disappointed the market, and the shares were down by 10% in after-hours trading. The reason being that Netflix reported a tailing off of new subscriber numbers, which seems to be happening as lockdown is easing. Netflix has been one of the key beneficiaries of lockdown, and loads more people have been signing up to the platform to entertain themselves while they've been stuck at home. But now that lockdown is easing, it seems that these new subscriber numbers are really starting to tail off. Here's a chart that I took from Netflix results last night, which shows the numbers of new subscribers that Netflix has acquired each year to date. And as you can see, for the past few years, the numbers of new subscribers have remained fairly consistent, but have grown fairly steadily throughout each year. For this year, as shown by the red line, you can see there's been a huge spike in new subscriber numbers at the start of lockdown, but now that's really starting to tail off. And this is what has really worried investors. This chart really suggests that Netflix has been a temporary, not a permanent beneficiary of lockdown. So we'll really have to see what the future holds for Netflix. Moving on to next week, reporting season continues. Next week is quite a big one for the technology sector, and we've got results out from IBM, Microsoft and Amazon. That's it from us. Have a great weekend, and we'll see you next Friday.